All right, so BlackRock, of course, is all in on the Fed announcement yesterday, which has been a little bit more of a dovish signal that could set the markets into a tizzy. We're going to break it all down for you. It's going to be a good one. My name is Paul Barron. Welcome back into Tech Path. All right, so a lot has happened here just in the last 24 hours. The question is whether or not we're going to see a big move going into the markets. So stick around for this one. I think you're going to like it. I do want to get into our sponsor, and that is iTrust Capital. If you guys are looking at long-term holding of your digital assets, you want to put it on an IRA. This is one way you can go. And of course, this now going into tax season is a great time to maybe take a look at this. So go over to itrustcapital.com. You can use our $100 funding reward. And if right there on the front page, there's a couple of links I want you to follow. This one right here, which is called Tax Advantages. This will take you over to a blog post that'll get you into advantages for you. Again, we're not tax advisors, but it's a good time for you to maybe seek your CPA and your team's out there to look at this. So give it a shot. Use the link down below. All right, let's get into a few points here. I want to start off with this. BlackRock saying the Fed Chair Jerome Powell's speech is a green light for investors. This coming from BlackRock, I mean, I look at it this way, guys. I'm always worried that, when these institutional and capital guys really look at this as super bullish. And, the signals are there. Yes, everything's kind of lining up and in a perfect position. But there are some things that we need to be aware of. And I'll talk about those in a minute as we get into this. I want to continue on with this point. This is from Squawk Box, kind of a response. And it's really talking about whether or not we will get 1, 2, or maybe 3 rate cuts next year. Listen in.
We knew going into yesterday's decision in the press conference that the Fed felt that policy was already somewhat restrictive. It was already restraining the economy. Inflation was below its expectation for this point in the year already, and that they would probably be looking toward a pivot. Yet the market seemed to be surprised at the clarity of Chair Powell's comments, sort of delinking the economic path next year from the likelihood of easing. What stood out to you?
I think 3 things stood out to me. First was, in fact, the market reaction. I think it was probably outsized compared to what anyone would have expected, with Powell saying things that were, pretty obvious. Second, I would say, that they themselves are clearly feeling much more comfortable. 3 weeks ago, Powell was saying it's too early to even talk about rate cuts, and here we are 3 weeks later, and he admitted that rate cut discussion was at the table. I think he said something in that phrase. And then third, the real expectation of 3 cuts being so clearly pointed out in the so-called dot plot. So it was, for me, a move that was a little more firm in the rate cut direction than I had personally expected.
All right, so good thing is that many analysts kind of go along with what we talked about yesterday during the live stream. If you didn't check that, we usually live stream these FOMC meetings. I think the January meetings and February meetings are going to be the ones to watch, mainly because of the data rolling in for year end. But this was one of the things that we pointed out, is that Powell actually came and said we actually have a rate cut discussion on the table. I think that advanced a lot of people into this next layer of hope, which is kind of interesting. Carl Quintella here. Goldman, in light of faster return to target, we now expect that the FOMC to cut earlier and faster. We now forecast 3 consecutive 25 bips in March, May, and June. That would be pretty big if we got that first quarter. March is one that is very significant because it will be early enough in a cycle that could affect a larger run from a dynamic standpoint of how the markets might move into the summer. So timing, remember, timing is very, very critical around this. So interesting for sure. But the key here, and I want you guys to be aware of this, and we'll talk about this in a second around the ETF, is there's just a lot of other forces at work here. And one of the big forces that I'll show you guys is all about employment, because this could be the one thing. Remember, we've talked about this a couple times. What is the event that has to happen for a true pivot to occur? And the Fed may come in and just be very staunch and say, yeah, we're okay with this. Inflation is lowering. It will depend on jobs. That's going to be the key thing here. And I'll show you a chart here in a second. I want to jump over to a couple of tweets, though. FOMC is done. Dovish stance, most likely rate cuts. The high on the interest rates is in. For Bitcoin, risk off before FOMC took place, bounced back upwards, and I think the trend is going to continue up. What do you guys think? Do you feel like we are at a point right now where Bitcoin does go ahead and recover, pull back that in that reposition of 43 to 44K, and we see a 47 to 50 run? Is that where you think we're going? Drop some comments down below. Make sure and smash the like button. It does help the channel. Just for many people who maybe are first here, hit that like button right now. Maybe this is the first time you've watched a crypto video for the first time. Welcome into the channel. And it helps the algorithm, so it's going to help others kind of find their way into this market. Other topics here, you can appreciate the Fed's pivot. This was an interesting tweet in the so-called dot plot. The dot plot visually represents the interest rates projected over the individual members of the Fed Open Market Committee, obviously the FOMC. Remember, there's a bunch of these bankers that come together. Many think one way, some think another way, and that has been the issue with the dot plot, in my opinion. But projections, each dot plot represents the interest rate projection of an individual FOMC meter for the end of the year. Median projection, you can kind of see, and then the median projection for the Fed's fund rate by the end of 2024 went from 4.6 in June to 5.1 in September 23, back down to 4.6 just now, which is kind of where we're showing. And you can kind of see the layout of where the big cuts might end up, more so obviously in 2025, and repositioning in the longer run over the next few years. All of this is good for upward trends in a market where you see declining interest rate and we get down to maybe less than 1% Fed fund rate, which would initially stimulate the economy at any point on its way. I think that stimulates everything from business growth to housing, real estate. Obviously, we'll see that in the securities market as well. But what causes that to pivot? That's the question mark. So a couple of things could cause all of this to get shaken up. One, of course, is the spot ETF. Now, there's a few things happening here with the spot ETF. This is going on right now, and it's mostly a conversation between many of the applicants and the SEC as to the model in how these ETFs are constructed. So cash redemption model for Bitcoin. This is James Seyfried. Every Bitcoin spot ETF applicant will have to bend their knees to this new model. This is on the cash redemption model. Their latest cash redemption model came amid the spot ETF issuers ironing out their filings with the U.S. regulator, and the model enables authorized participants to deposit funds in an ETF equal to the net asset value that the creation units can be created. The underlying asset, which is in this case Bitcoin, are subsequently purchased by the fund using this money. So it's truly a cash in, cash out to purchase versus, kind of the in-kind model that has been done in the past. They also asserted that Invesco is the most recent company to adopt the cash creation redemption ETF or standard for its ETF. And then for in-kind model, the participant deposits collection of securities that are weighted and composed in accordance with the ETF's portfolio. This allows investors to receive creation units from the fund without having to sell the securities for cash instantly. So that is a big factor there. The in-kind redemption model is what BlackRock is really trying to get in on, and they kind of lay it out here, but it's easier for Wall Street banks to participate in the fund if they use this model. With this modification, authorized participants would be allowed to issue new fund shares using cash instead of just Bitcoin. It's an accounting mechanism for these ETFs, but it's more of an investment instrument overall. But I think it is going to be the cash redemption model, most likely, that the SEC does approve. We'll see how all this plays out. Coming in, probably obvious at this point, but seems like the SEC never asked Grayscale to refile its Bitcoin spot ETF proposal after losing to the asset manager in court. The agency has been engaged with Grayscale's existing application. So I don't know. That's an interesting position right here. And I want to say something to you guys, and I put this tweet out this morning, and really, I just want to kind of showcase a couple of points right here. And that is, what would be the thing that could cause a pullback dramatically? There's a couple of things that could play into this, but this is mostly on an investment side. And I'll talk about another potential black swan that, maybe not a black swan, it's more of a swimming swan that's coming at us. But ETF not approved right now, number one on the list. But I was surprised that a regulation hit would be almost equally concerning, and then a war and or a political event. That was kind of the issue. So an ETF not getting approved, and I want you guys to put this in your mind right now. Even though we're seeing all this positive sentiment, this isn't done. This ETF is not guaranteed. And if it does not get approved, there will be a major market correction. Now, remember, you still have the Coinbase case coming up in January as well. So that could soften that blow somewhat. This would not be an exit the crypto market event, but it would definitely put us back into the fight with the SEC. And it would put us into the fight with a lot of companies that have spent a lot of time and money going in this direction. But I want you to be prepared. Now, granted, what's the percentage? It's somewhat lower, but I would look at this still as a 90+%, but you just cannot rule it out. A couple of things in here. Also, Valkyrie submitted a new S1. This was at 6 o'clock this morning. They're joining Bitwise and Invesco. So they're all going in the direction that appears that it would allow the SEC, because they seem to have dug in on this position. So just a point to make right there. Bitwise Spot ETF was listed on the DTCC, which is another one, which is going to be called BitB. The DTCC is getting ready for an actual exchange to where you can trade on that ETF. So that in itself is also another signal going in the right direction. There are a few things, though, that are happening here on this article, is that even though Bitcoin could still run, even if we don't get a spot ETF approved. So there's a few points within this that I agree with. Increased liquidity in Bitcoin, the halving event, obviously we already know. You got potential shift in the administration, the government, including obviously the presidency. And then you've got a lot of potential money market funds that could still come into the market in terms of liquidity. Remember, there's about 3 to 5 trillion sitting on the sidelines right now. That's a big deal. So 3 trillion, 6.1 trillion. That can easily find its way into risky investments like stocks and crypto. So there would still be a lift, just not through the ETF. Remember, the ETF is only, in my opinion, a poster board or a bulletin board of the market being considered mature. That's really what it is. It's kind of the poster child of saying, oh yeah, no, Blackrock's in it now. It's, everybody else that has been out of crypto, maybe we see enough there that would draw it. I still believe there's going to be a correction off of it where it's a, buy the rumor, sell the news kind of scenario. And then you'll see market resume as usual. Yes, you might get a 10, 15, 20% correction, typical market moves. The one that could cause a major hit is a denial. That could go plus 30% in the correction model, specifically in crypto. And that's going to affect everything. That's going to affect altcoins. It'll obviously affect Bitcoin and Ethereum. And it will also have some effect even on Web3. So all that playing into this. Now, with that being said, you've got, of course, JPMorgan has tripled its internal crypto team while its CEO is bashing Bitcoin. So watch what they do, not what they say. I would agree with that also. I think there's just been a lot of narratives throughout the years by Jamie Dimon and others, even Larry Fink, from Blackrock, not necessarily a Bitcoin lover, but all of them eventually bend the knee, and I think that's what's going on right now. Other point right here, this was just a headline on Grayscale CEO taking a jab at, guess who, Mr. Dimon. And he says basically that and recently he took a subtle jab at Dimon, and the reason is we want to close it down. Now I'm just confused. JPMorgan suggesting Ethereum could outperform Bitcoin in 2024. So which is it? I mean, Morgan is now bullish on Ether, but not Bitcoin, but yet they're hiring analysts and researchers. I mean, you get the picture real quickly. All right, so what you see with JP Morgan being bullish on ETH could flow into some other scenarios. If you go back to that article I was just showcasing, because remember, Donald Trump obviously put out his whole collection on NFTs, cards, etc., just did another drop, all driven off of Ethereum. So if Trump gets in the White House, is he championing ETH in a way? Is that the asset of choice by potentially a new president? That would be a very interesting scenario. And of course, he did this with his new mugshot edition of his NFT trading cards. If you guys haven't seen that one, it's kind of an interesting thing for sure. Okay, so last thing I want to hit on, guys, is this right here. This is the unemployment rate over really the last 20 years, okay? And I want you to notice something. This, of course, is for those of you who didn't live through the 2007, 8, and 9 years. That was a major hit on the American economy. And it was the last time we saw unemployment outside of, you know what, hitting us at 10%, double digit. In fact, that was on October 2009, where we hit a double digit unemployment, not induced other than what we saw on the financial crisis. Now, if you look at this market right here, we're starting to lift up right here. You can kind of see this 3.7, even though it dipped slightly, but it was at 3.9 in October of this year. And then you look back at this little move right here. These has a lot of eerie scenarios. So are we in a position where labor has been coiling up because of all this pressure on and from the Fed into the markets? Businesses, laying off left and right. We're seeing finally a large amount of business that's not starting to affect consumer credit. First time we saw consumer credit on a reversal, meaning less consumer credit being spent, meaning simply they're maxed out on their credit cards. And this is the next step. And that is if we see double digit or anything that is remote to a 5% unemployment, that could be the one thing that causes a pivot from the Fed. So labor is the one to watch. The retail numbers that we'll get toward the end of this month and into January, those will be very significant because it will affect labor and business going into Q1. Remember, retail, restaurants, hospitality, biggest injection of new workers in the economy. And if they see a softer market, they're going to pull back. If they pull back, it would have the most impact on labor. And that is a problem for the Fed because that does show that the Fed has basically put the gas down too hard and it's now damaging the economy. And that's what they don't want to do. So all that being said, hopefully this gives you guys a little bit of an indicator. Keep your eyes open. Always be ready for these unexpected scenarios. Don't just assume we are up and to the right. Just be aware. Smart investing is always knowing that there are options and a lot of flexibility. So just be focused on that. If you're not in our Diamond Circle, make sure and get in now. It's one of the places that you can get additional content, more alpha. We do a couple of podcasts over there, so it's very easy. Look, click the link down below and you can get to it. It's very simple. And then if you guys aren't following me on X, make sure and do that now. It's just @PaulBaron. We'll catch you next time right here on TechPath.